Time to get started. So just wanted to, this is Bill Burkhart, the president of the Investment Integration Project. Just wanted to start by welcoming everyone and thank you for, if you're on the East Coast, making time during your lunch hour. And for everyone on the West Coast, hope you're nice and caffeinated and ready to go. So this is an exciting opportunity for us. TIP is a relatively new initiative, but to have this opportunity to partner with SASB on this webinar, it's very exciting for us and reflects the continued discussion between our two efforts and really thinking through how we bridge this divide between portfolio level decision making and systemic frameworks. Over the course of the next hour, we are going to explore a couple of key dimensions. First, what asset owners can do to help bridge this divide between portfolio level decisions and systemic frameworks, what asset managers can do to stay ahead of the curve, and what SASB standards and TIP resources can do to help. So over the next 60 minutes, the rough roadmap we're going to be working with is I will set the stage with a few framing remarks. Steve Leidenberg, the president of the Investment Integration Project, will come in and give a high-level presentation about TIP. Janine Gilliatt will come in and give a high-level presentation about SASB. We'll do a engaging Q&A over the course of 30 minutes. We'll then turn it over to the audience for additional questions and answers, come back with some final remarks from Steve and Janine, and then I'll provide a few closing thoughts and next steps. So just to open us up, if you want to go ahead and hit the next slide. So Claire Miller, who is the head of the Heron Foundation and a board member of SASB, famously comments that all investing has an impact. The rub is whether or not you actually account for it. And nowhere was this truer than on September 15th, 2008, when our financial system really came close to complete meltdown. The worst case was avoided, but the collapse that day of Lehman Brothers, with its $600 billion in assets, helped trigger a worldwide economic crisis. Some 6 million people lost their jobs, the Dow plunged 5,000 points, banks needed government bailouts, General Motors and Chrysler declared bankruptcy, and the U.S. unemployment rate skyrocketed to almost 10%. All because a few very smart people making rational decisions to boost portfolio returns turned a blind eye to the systemic risk they were creating. Next slide. In the 7 years since, a great deal of progress in stabilizing financial markets has been made. And in the responsible investment space in particular, new strategies, tools, and metrics have emerged to better capture the environmental and social consequences of investing. This comes from our friends at PTGM, and it represents a smattering of interesting leading actors that are beginning to embrace impact and integrate impact in investing along the kind of continuum of opportunity. Now, these groups and a whole host of others are using all these different resources that have emerged or have been created to help with this. So everything from sustainability reporting guidelines like the Global Reporting Initiative to impact and sustainability metrics like the Impact Reporting and Investment Standards or IRIS and SASB, and ratings and analytical tools like GEARS, B-Impact Assessment, B-Analytics, and B Corporation certification. And even at a more mainstream level, you have Bloomberg, Thomson Reuters, MSCI, Morningstar have also begun to offer ESG research data to help with investment analysis. However, these fundamental changes remain elusive, despite what many would like to think. Go ahead to the next slide. The same asset owners that are making relatively little effort to relate their investment decisions to their impact on global, environmental, social, and financial systems that they operate within. Next slide. Or vice versa, that we're still not seeing how a lot of these systems are impacting individual investment portfolios. And so it is against this backdrop that both SASB and TIP have emerged. Now, to go deeper on what is happening and the strategies that TIP and SASB are pursuing, I'm now going to bring in Steve and Janine to talk about both of these efforts and really start to answer the question of how efforts like SASB and TIP can help bridge the divide between portfolio level decisions and systemic frameworks. So I'm going to throw it over to Steve now, who's going to give us a kind of the overview of TIP, capturing the progress in responsible investment, what our strategy and approach is, and what really the end game looks like. Steve, you want to take her away?
Thank you, Bill, and I'm glad to be able to say a word or two about TIP, the thinking behind it, where it came from, what it is, and where it's going. I want to start by saying that I think this is really a unique moment in many ways. It's very encouraging for responsible investment. I think we find ourselves in a position where there is a very broad interest in responsible investment, a lot of momentum behind it, and that momentum is stronger than it has been in the recent past. I think it's fair to say that the concept is one. You'll see the CFA Institute in a recent white paper talking about how ESG integration is part of a better informed investment decision-making process. You see Larry Fink, the CEO of BlackRock, writing a letter to the Fortune 500 CEOs urging them to develop strategic frameworks for long-term value creation. You see the impact investing world with its definition of investments as having intention to create social and environmental value along with financial value, having achieved great widespread interest. And many, if not most, of the major financial services institutions are now offering responsible investment product. Goldman Sachs recently acquired Imprint Capital, one of the foremost impact investing firms. Morgan Stanley has its Institute for Sustainable Investment and is positioning itself as a thought leader in this area. There's increasing talk about integration of ESG into security selection for equity, something that SASB has been playing a key role in promoting. And in the fixed income world, you see folks like PIMCO signing up for the Principles for Responsible Investment and strong interest in green bonds. But it's hard to say where this is all heading. There is, despite all this progress, still skepticism about what is happening. Are all these efforts in the products just product area, just niche products, and the financial services industry is still doing its mainstream products just the way it has always done it? Is the integration of ESG just one more factor, but one among many factors, and there is no real change in terms of what the fundamentals are, either of the product offerings or the tools for analysis? So that's the question that we began struggling with about a year ago. One way of formulating what this dilemma is to ask. We were asking ourselves, well, what would real change look like if it occurred in this financial community? What would be the simplest question you could ask that would indicate that something fundamental was changing in the way finance was being thought about? And we ended up with focusing on one question. It's a relatively simple question, and that question is, does investment at a portfolio level have impact beyond the portfolio? Does it have impact at the basic environmental, social, and financial systems levels that are those systems that are the foundations of the whole investment process? Is there a kind of feedback loop between these large systems and the portfolios, where the systems affect the portfolios and the portfolios in turn affect the systems? In a certain sense, this is a relatively simple question, but a couple of recent examples really indicate the relevance of this question and the importance. And as Bill indicated, the 2008 financial crisis certainly was one of them. But I would also argue that the current situation with climate change is another similar situation, although it is emerging now. We're in the midst of it. It shows how profound systemic level uncertainty can complicate investment and how investment can complicate that uncertainty. So now it is certainly clear also that a lot of work is being done at both the portfolio level and at the system level to talk about impact. We have the GIN and IRIS doing evolving a very sophisticated system for measuring impacts of impact portfolios. We have the Carbon Disclosure Project and TrueCost doing carbon footprinting for individual portfolios. And we even have Morningstar, which is announced that by the end of this month, it will be providing public ratings of the social and environmental and governance characteristics scores, actually, of every mutual fund that it also provides a financial star system score for. And at a systems level, running parallel, we have a lot of serious people talking about a lot of very fundamental issues about progress, social and environmental progress at a systems level. You have the folks that are working on alternatives to GDP, to gross domestic product, the Stiglitz and Fatosi initiative that's underway, the social progress and genuine progress indexes that are out there. You have various measures of natural capital, the whole systems for natural resources. Is that progressing? Is that getting richer? Is it being depleted? You have the United Nations measuring Human Development Index. This is not even mentioning all the work that's being done by governments, by the United Nations Environmental Program, and others envisioning a financial system, what is necessary to do for a financial system that is stable and sustainable. So those two efforts are going on. However, there is relatively little connection being made between the two. Now, although this connection is being thought about in certain areas, there are some pioneering work that are being done that I think are quite innovative and significant. A couple of these actually come out of the University of Cambridge. They recently published a study called Unhedgeable Scenarios on Climate Change, and translates those scenarios back to the portfolio level. And they argue that some of those risks from climate change can be hedged, but about 50% of them cannot be hedged. A similar study out of the University of Cambridge Center for Risk Studies looks from a social stress point of view. So looking particularly at stress caused by youth unemployment, they again use scenarios to project out different levels of risk to society in general and bring that back to translate that back to a portfolio level. Raj Thamatharan and Howard Covington at Preventable Surprises have done a similar study on climate change risk and its potential effect at the portfolio level. You have the UN, the Principles for Responsible Investment, considering a seventh principle that has to do with systemic risk. There will be a year-long discussion leading up to the next annual meeting of the PRI in Singapore in October about this possibility of a seventh principle. And you have the Financial Stability Board forming this task force on climate-related financial disclosure, again, drawing the connection between systemic risk at the climate level and financial implications. So certainly, folks are thinking about it and making some progress in doing it. And it's in this context that we have decided to go ahead with the TIP project, which is, as Bill was mentioning, a relatively recent initiative, and its purpose on this important issue to collaborate with others. And we started with a white paper, which we published, put out for as a exposure draft last November. It's on our website about the background on this issue, how we're thinking about this issue, why this particular formulation might be a useful one. We held a convening at the Boston Federal Reserve again last fall. Plan a second convening coming up later on in the year at the San Francisco Fed. Started in with dialogue with key players that are already working in this area. We're planning a casebook on best practices by asset owners and asset managers, who's doing what already in this area, folks like PGGM or CalPERS who have started down this road, demonstrating where they're heading, looking at the variety of different approaches. So that is our general purpose, and our goal is to collaborate and catalyze this kind of research. Essentially, we are focusing on the need for research in this area, research that will support asset owners and asset managers, and a variety of asset owners and asset managers. So this research is potentially useful not only to pension funds, but also sovereign wealth funds, insurance companies, endowments and family offices, even development financial institutions, or potentially even central banks, all of which are asset owners that are long-term, and because they are long-term, they have an inherent interest in the systemic risk to their overall portfolios, the long-term effect that systems have, either creating a rising tide or a falling tide on all portfolios. Certainly this is all relevant to asset managers, whether they be large financial services companies, the pure play responsible investment folks, the impact investing folks, those specializing in specific asset classes such as fixed income, where there's more and more attention to this area, real estate, where there's some very creative work starting up, private equity, etc. So those are that's sort of the purpose of the TIP project and its general strategy. I think it's worth asking one additional question at this point, which is where is all this headed? What would it look like if actually this gap between what's going on at the assessment of impact at the local level, at the portfolio level, and what's going on at systemic assessments at the much larger, more macro level, what would it look like? What are the implications for investors and how they would position themselves? And this slide here is an attempt to think about this in terms of what would happen to reporting. Right now, asset owners, asset managers report out essentially at the portfolio level, and their reports are very sophisticated. We are very sophisticated at reporting portfolio performance relative to benchmarks, relative to peers, relative to various absolute return goals. But a second kind of report, the implication of where I think this is all headed, is that there would be a second kind of report, and that report would go to the systemic framework level, and it would include the asset owners or asset managers' conception of what frameworks are particularly important to them, that they are particularly focused on, an acknowledgement that their investment policies and practices have an effect, have an impact at that level, and that they are working in one way or another to manage the risks and rewards that exist at those. Now, you can't forget the portfolio or the systemic level reporting. I think we are very strong on portfolio level understanding of our impacts. I think we are still relatively weak on understanding our impacts at the systemic level. So we need them both, and we need a balance between the two. And that is one of the reasons why we're particularly pleased to be following the work of SASB, because not only is it developing key metrics for industry level risks and rewards, but now that it has gone through the arduous task of 2.5 years of developing those assessments of risk at an industry level across all 79 industries that it covers, it can see what issues actually cut across all industries, and it defines those issues that are systemic, or describes issues as systemic, as ones that cut across maybe 50% of the industries. And in the case of climate change, it's very dramatic. It affects 72%, 72 out of 79 of those industries. And that is the kind of work that we need to document the systemic issues. So that's one of the reasons why we're particularly enthusiastic about SASB's work. We think it'll make a great contribution in elevating the dialogue to this area. So with that, I'm going to turn this back over to Bill and Janine.
Okay. Great. Thanks, Steve. That was a really, really terrific introduction. So I'm Janine Gilliard. I'm going to talk about SASB and what role SASB plays in facilitating responsible investment or integrating environmental, social, and governance factors into investment decision-making at the portfolio level. And as Steve mentioned, I also think our work informs thinking about systemic risks that exist at the system level. So SASB is a nonprofit organization. We're formed to develop a market standard for disclosure of sustainability information. And we are very focused on identifying sustainability information that is material, meaning that it could impact financial performance, that is cost effective to provide, and that is decision useful to investors. And we're developing those standards using a rigorous process that is modeled after the process used to develop accounting standards in the U.S. And that process is research-based, it's got broad stakeholder participation, and it's transparent. So how is SASB different? SASB standards are designed for use by investors. We're sometimes asked, why should corporations adopt the SASB standards, particularly corporations that have done corporate social responsibility reporting for many years? And our answer to that is that CSR reports tend to cover a very large number of topics that are of interest to multiple stakeholder groups, whereas the SASB standards are focused on a relatively small number of topics that could impact financial performance and therefore are topics that are of interest to investors. And we're focused on sustainability disclosures that are material, decision useful, cost effective, industry specific, evidence-based, and very importantly informed by market participants, and those market participants are both investors and issuers or corporations. So SASB envisions a world where corporations compete on performance on sustainability metrics, just like corporations compete on performance of financial metrics today. But to do that requires standards. We have to have consistent disclosure topics, and we have to have consistent metrics so that both investors and corporations have access to comparable information. And with comparable information, it's possible to benchmark performance, and it's possible to set targets for improvement on sustainability metrics, just like you'd set targets for improvement on financial metrics today. So SASB standards benefit both investors and issuers. The standards give investors access to decision useful information that's material, that's industry specific, that's comparable, and very importantly, that's reliable. We envision that ultimately SASB metrics would be reported publicly in the Form 10-K, which is a trusted channel that's subject to internal control and that investors have come to rely on. But although the SASB standards were developed for investors and they benefit investors, they also benefit issuers or corporations. They set a minimum set of disclosures of material information. Wherever possible, we've looked for metrics that are already being computed or disclosed in some form so that corporations do not have to compute new information. And as I mentioned earlier, the information would be publicly available so that boards and senior managers can benchmark themselves against their competition and set targets for improving performance. I want to talk briefly about the themes that have emerged from SASB standard settings process, and this goes back to some of Steve's earlier remarks. SASB sets standards by industry, and to date we have developed standards for 10 sectors, 10 broad sectors comprised of 79 industries. But common themes have emerged across those industries, and the most significant theme that has emerged is climate change and the risk of climate change, which manifests itself across almost all of the industries for which we've set standards. But the important point is that although climate change is a risk across almost all industries, it manifests itself differently in different industries. So for oil and gas production, clearly carbon intensity of reserves is a key risk, but for insurance, the most significant risk may be vulnerability to extreme weather events, depending on where they have underwritten their policies. Or for agriculture, the most significant risk may be the impact of extreme weather or water availability on crop yields. So to connect back to Steve's opening remarks, SASB began with a very bottom-up view of identifying material sustainability risks by industry. But as we've nearly completed our work and as we've issued provisional standards for almost all sectors, these broader strategic themes have emerged that are systemic in nature and systemic risks. What's very important, though, is to remember that it's not a one-size-fits-all, that different systemic risks will manifest themselves differently in different industries. So we need to have this conversation at both the system level and the portfolio level and the industry level. And I'm really looking forward to taking your questions and having a conversation with Steve on these topics.
Great, thanks, Janine. So we're going to just leave this up here just as our kind of North Star to guide the conversation, really get to that, answer that at a very practical level. What is SASB and TIP and others doing that are helping to bridge this divide? I think we've just now heard a lot about systemic frameworks, intentionality, materiality, and anyone that's new to this space and new to SASB and or TIP, their brains might have melted through the course of that conversation. So let's step back for a second, maybe just do a kind of baseline. So maybe start with Steve. Really emphasize here, who exactly is TIP serving? Is it asset owners? Is that who the primary audience is? Or is it asset managers? Is it some combination? And maybe talk a little bit about why TIP is focusing on who it is focusing on.
Yeah. Yes, that's a good question, and I think our goal really corresponds with the goals of those people that are concerned about long-term investing and sustainability. And the questions involved in systemic risks are really the same kind of questions that are involved in figuring out where long-term value creation lies. Long-term value creation is in vocabulary that kind of value creation that raises the tide for all ships. The longer the investment horizon line for investors are, the more inclined they are going to be to give weight to that rising tide phenomenon. So our focus is on those asset owners that have and asset managers that have identified their long-term, they have a long-term horizon. Some of those asset owners and managers are those that have pension funds with long-term liabilities, life insurance companies that has matching investments to long-term payouts, sovereign wealth funds that are accumulating funds for the long term. Norge Bank, I believe, says it has a 100-year investment horizon. When you have those kinds of horizon lines, then your concern for a system is going to be the greatest. So those are our primary focus. And we believe that as asset owners, they are also in a position to influence the basic dialogue and practices of the financial community by asking for their managers, for asking for the creation of, creating the demand for a product that addresses systemic issues, by asking their managers, whether those managers be internal or external, to report, to think about and report along systemic lines.
Okay. And Janine, I mean, same question to you. So you emphasize investors and issuers. What's the rationale behind that? Why are you guys focused the way you are, given, particularly since you guys are seemingly achieving a new level of understanding around materiality, particularly when it comes to integrating ESG issues? where, something like the impact investment world that's sprung up is very much focused on private, private funds, private enterprises, small to medium-sized enterprises. Why is SASB taking the focus that it's taking?
Yes, so that's a great question. So we would answer similarly to Steve that we are very focused on investors, and the natural audience of investors are those who have very long time horizons and therefore are interested in what are the conditions that are going to give rise to stable returns over a very long time horizon. Having said that, we also really want to be investment strategy agnostic. So view SASB as a market infrastructure provider. Our goal is to set standards for disclosure topics, set standards for metrics, so that investors have access to a baseline of quality and reliable information on which to base decisions. Those investors may be long horizon investors, they may be short-term alpha-seeking investors, they may be fundamental investors, they may be quant investors. We're not advocating for any single investment strategy. What we're advocating for is that all investors have access to a quality set of baseline metrics to incorporate into their investment strategies.
Okay, and I heard you say, when you guys think about, as these broad themes are emerging, that a lot of it, even though you cited a number of different kind of motivating factors here for why SASB is doing what it's doing, risk mitigation was one of the comments that you seem to focus in on. And I guess, bringing both of you into this, is this fundamentally just about risk mitigation, or is this really about reward seeking as well? Steve, maybe you want to start?
Yes, I think that's an excellent point, and I think that the financial community, for a variety of reasons that have to do with the historical evolution of the theory of finance, is focused very much on, rightfully so, on risk and how to manage risk. Reward here, particularly at a systems level, is very important also. There are the rewards from having a stable financial system, for having a stable and rich environmental system, for having a society that is progressing. Those rewards accrue to all investors, and they're very important. Let me just give a couple of examples. I think the concern with bottom of the pyramid, poverty alleviation, is exactly that kind of systemic issue that would benefit all investors, and those companies that are concerned with marketing to the bottom of the pyramid, those investors that are concerned with community economic development and poverty alleviation, they are contributing to a kind of positive reward side of the equation, which is equally important. So I think that both need to be taken into account. Similarly, concerns about health and a healthy society and its various manifestations. Those are another example of sort of an area where concerned with the positive aspects of the system will benefit all.
Yeah,
yeah,
and
do you want to jump?
Yeah, I would just add that I think when talking about risk, and increasingly investors are talking about ESG factors through the lens of risk, it's really important to distinguish what type of risk we're talking about. And there are certain risks that can be mitigated at a portfolio level by making decisions about buying and selling a specific security, or what an allocation is to a sector or a particular asset class. Those are certain kind of risks that investors can manage through their investment decision making and their capital allocation decision making. There are other types of risk that are more systemic and that therefore really can't be mitigated by actions at a portfolio level. And climate change is an example of that potential kind of risk. Those risks can only be managed by actually actually impacting whatever is causing the change, which I think is why you increasingly see some of the big long-term asset owners who are very active on policy, and it's really because they're making the connection to systemic risks and the need to manage the impact that systemic risk can have on their portfolios. I think it's very important when we talk about risk that we're very clear about what kind of risks we're talking about.
Yeah, Janine, that's helpful. That kind of nuance is definitely helpful. I'm going to get to the next section of questions. I just want to quickly just throw out a prompt that if anyone has questions that are listening in the bottom right-hand corner of the screen, you can actually start submitting questions. So feel free to fire away, and we'll incorporate them as we go and or towards the end of the session. So let's get into some of these lingering challenges and start with Janine. You know, getting agreement on what is material within these different industries. Maybe you could talk a little bit about the challenges that you guys encountered developing a lot of these standards. And partially I asked this, or I raised this, because I know that as Steve and I begin the process of identifying and really exploring different systemic frameworks, there doesn't seem to be a lot of universal agreement on what constitutes a systemic framework. So let's start with Janine. Maybe you could talk a little bit about you know, your guys' process for how you got to where you're at, and what are some of the insights that you guys might have gleaned from it, some of the challenges you encountered. And then throw it to Steve to talk a little bit about what we're seeing in terms of a basic agreement on what constitutes a systemic framework and what doesn't.
Yeah, so that's a great question, Bill, and let me just say first, I think that 100% agreement is absolutely impossible, and I think that to me is the exact reason why SASB's process is so important, and why the concept of modeling the SASB process after the process used to set accounting standards in the U.S. is so important. Because what we need is a process that will ultimately drive towards some kind of consensus, and very importantly, a process that lives on an ongoing basis. As new issues come up, can be evaluated and considered for disclosure, so that we have a living and breathing and ongoing process that can enable standards to evolve, which is exactly the way accounting standards work. So briefly, to talk about our process, it's a research-based process. It starts with an identification of the universe of potential ESG issues. It's then a research-based process that the team looks for evidence that those ESG issues have had an impact on financial performance, either revenue, expense, valuation of assets or liabilities, of cost or capital. It's then a working group process where feedback is obtained from both issuers and investors in working groups, and we then issue an exposure draft for public comment. That's the process that has led to the development of the provisional standards that exist today, and we're now entering into a period of deep consultation with issuers to get feedback on these provisional standards. Once the provisional standards are codified, then we will continue to maintain those standards using a similar process. So I think that's important, and I think it's important that that process be transparent, and that both issuers and investors have the opportunity to participate in it, and to know that it's an ongoing process, not a one-time process. And that way we get to some sort of at least consensus, if not 100% agreement.
Okay.
And one other thing I would add, Bill, one other thing I would add to that is that I think the SASB standards are a baseline. There are always going to be investors who, for whatever reason, whether it's based on their investment strategy or their values, are going to want some incremental level of information. And I think we just have to acknowledge that. But we need to reach consensus around some baseline set of metrics that will be publicly reported.
Yeah. And so Steve, maybe talk a little bit about what is the kind of quality of the, understanding and field around thinking around systemic frameworks? What are you encountering now as you start this? And how do you see the kind of TIP process unfolding in terms of capturing what's out there and codifying insights around them?
All right. Yes, I think that's a key question, and I think a number of different players are coming to this from it at a different way, and then there are certain underlying characteristics about how they're doing it. PGGM has talked a lot about their solutions-based approach, so they're looking at 4 themes where they see solutions, and those themes are very broad: health and water, and very broad solutions that really have a systemic quality to them. And similarly, when CalPERS talks about its 3 capitals that it looks at, the environmental capital, the human capital, and the financial capitals, that they are, again, thinking at a kind of systemic level. And the kinds of characteristics that underlie these kinds of thoughts are thinking of issues that have a very broad scope and a broad consensus around them, that create these kinds of rising and falling tides that I talked about, and that have to do systems. If you look at the thinking about systems that comes out of the ecological world, they have to do with resilience and stability. So there is an importance in the financial world, particularly in funds where you're in a spend down mode, for having predictable systems. So resilience and stability is important in the face of uncertainty. So those are the kinds of characteristics that would be important in thinking about what is a framework system, what qualifies as that, a framework system. So in the financial services industry, a lot of the focus is on risk, but financial services, key to the financial services world is data transparency and honesty. So disclosure becomes a systemic kind of issue for the financial services industry that has those characteristics. It's broadly recognized. There's a broad consensus that disclosure is important, and that it can facilitate finance, create a rising tide for all, and creates a resilient system that helps address uncertainties. So those would be the general characteristics I would be looking for.
Great. So it sounds like much in the same way that there's quite a great deal of sunlight in terms of what SASB is doing, and TIP will look to operate similarly. So I want to get into, so once again, just as a, if anyone has any questions from those participating, please feel to fire them in. We'll get to them in a few minutes. I want to quickly shift now to the investor perspective, and then get into some kind of breakthrough insights opportunities. So, right at the top, we talked a lot about all of this kind of growth in terms of whether it's GRI or Gears or IRIS or SASB. There's just so much activity underway. And as an investor, how do I begin to make better sense of what's happening and to be able to integrate all of this information in a way that makes better decisions for me or the money that I'm managing? And with particular emphasis on, maybe the linkage between how SASB and TIP might potentially work together, but also really just getting better as an asset owner or manager. How can I be a better consumer of either of your services? So maybe we'll start with Janine. Blank canvas, all the paint's in your hands. So paint us a picture.
Yeah, so that's a fantastic question, and I think we've been in a period of intense innovation and exploration as really people have started to talk about integrating ESG into investment decision making, and have really started to think about how to do that. I think we now need to evolve to a period of saying, how are we going to run scalable investment strategies across billions, if not trillions of dollars of assets, and that is going to require data, and I believe that will require a market standard. That will require coalescing around a market standard of some minimal set of publicly available data that can be accessed in an automated form by big investors, and that's when they'll be able to scale their investment strategies. So I think sometime in the next few years, the industry needs to coalesce around a market standard for both what topics will be disclosed and what metrics will be disclosed, so that that information can be consumed by investors. And I believe that will happen over the next few years.
Okay. Steve, same question. How can investors start to make better use of what TIP's doing and just generally be a better consumer of the insights that are going to be coming out of it?
I think one of the challenges that we all face is that we've been extremely well trained to understand and look at our portfolios and what's going on at the portfolio level. And I think that as we start to see and use and look at reports such as the ones that I mentioned that the University of Cambridge has been putting out, or Preventable Surprises has been putting out, we can start training ourselves to look more at a systemic level as well. And that's, it's actually not an easy task to see how to get from here to there, and taking a careful look at those studies that have been done that help us get from here to there, I think will be a very important first step in that direction.
Okay. So I want to shift now to kind of, in our last couple of minutes, yet again, if anyone has any questions, feel free to shoot them over our way. So let's talk a little bit about breakthrough insights and opportunities that are needed to essentially push the field forward a bit more. Let's start with Steve. You know, you've now put out the white paper that really lays the conceptual grounding for thinking about systemic frameworks. And you've got a casebook underway that's going to be collecting a number of best practices, evidence of folks doing things, and you've also started making headway on really trying to figure out how to identify systemic frameworks and what some of those systemic frameworks might currently be. So what are you learning so far? What are some of those kind of interesting insights or revelations that you've come across as you've begun this work that would be useful just for folks to know even at this early stage?
Well, I want to stress that this work that we're doing is really runs in parallel with a lot of work that's being done by organizations such as Ceres and the UNPRI that are working with asset owners and money managers in this area. And I think we're all feeling our way to that kind of moment where we see that some of us are working on environmental issues such as climate change. Some of us are working on social issues such as human rights. Some of us are working on financial issues such as stability in the financial system. And I think what is interesting to me as we start looking at these different efforts in each one of these different areas is teasing out those underlying themes, those themes that tie those different issues together, and figuring out how all those issues areas will work in almost a collaborative way to create a mosaic of concerns that can really address the larger systemic problems that underlie them all.
Okay. And Janine, we can keep it at a high level, but I know that you guys are either you have released or you're in the process of releasing new guidance to drive more productive conversations about integrating ESG issues into fundamental analysis. Could you maybe talk a little bit about what SASB is doing within the financial services industry?
Yeah, so we have released an implementation guide which is targeted towards issuers who are interested in adopting our standards, that walks issuers through the process to adopt the standards. We're also very focused on developing tools for investors. And so in process, we have an engagement and integration guide. And what we're really looking to do is share best practices for integration of material sustainability issues into investment decision making. So those guides are in development right now. We also have our FSA credential, which is our Fundamentals of Sustainability Accounting credential, which is relevant for either issuers or investors, and that is available through our website.
Great, great. So that actually segues into the next question. So if someone, they're still hanging on here, and they bought the car, but now they're kicking the tires, what are some of those kind of practical next steps that folks can do to engage further? It sounds like SASB is offering a credential that can help get folks trained to move in this direction. Anything other particular opportunities related to SASB? And same with you, Steve. What are some of the resources that will be coming online soon in regards to tips? So, Jean, do you want to continue that thought? Is beyond the credential, is there a few other things that folks could be doing?
Yeah, I mean, I think the most important thing for people to be doing right now is really be very thoughtful about how the concept of integrating ESG into investment decision making really is applicable within your organization and your culture, because it isn't one size fits all. And I think thinking about how the SASB framework can be a tool, and particularly the focus on material information and material factors, how that can be a tool for thinking about how to integrate ESG into investment decision making within your organization. I think that's a very practical thing that people can be doing.
Great, great. Steve, do you want to talk a little bit about some of the resources that TIP will be providing going forward?
Yeah, so we've identified a number of research topics that will enrich the dialogue around this area. So we have, as I mentioned before, we'll be doing a casebook which would look at something like 50 asset owners and asset managers and their best practices in this area. It will look something like the PRI reports, but we'll have much more of a systemic focus on it. We have identified areas such as what makes a credible framework, how you identify frameworks, and how you look at frameworks in a way that's legitimate and credible as an area of research that we are continuing on at the moment. And the whole question of measurement, what happens to measurement, and how the measurement systems that are being developed at a portfolio level relate to the measurement systems that are being developed at a systemic level, and what are the kind of intermediate steps that allow one to walk from one level to another and back again. So we're doing some work in that area, and again collaborating with others that are working in this area to do so.
Great, great. All right, so Jill, if you could go ahead and hit the next slide. So I'm going to quickly just go through some of the big takeaway ideas from this session, and then flip it back to Steve and Janine to give us maybe some nuanced takeaways, or just the kind of final thought they want to leave folks with. So big thematic heading here: how do we bridge portfolios and systems, and what are some of those concrete steps? The first step is acknowledgement, just that investment decision making at a portfolio level and at systemic level risks and rewards are interlinked. The second is that you need to figure out what's relevant to your portfolio and what systems you actually care about, and then focus on them. And then the third step is, once you've done that, to actually implement policies and practices that lead to the preservation or enhancement of these systems while also being mindful of the health of your portfolio. So those are those kind of three big, 10,000-foot perspective takeaways. But I'll flip it to Janine. Do you want to say kind of what you would like folks to really walk home with from this session?
Yeah, I think I'll just reiterate what I said earlier about being very clear about when you're trying to manage a portfolio level risk and when you're trying to manage a systemic risk, and what are the tools that are available to you for managing those different types of risk. A systemic risk tool is more of a policy level action, whereas a portfolio level tool is more of a, I'm going to divest of a security. I think it's just very, very important for people to be very clear which types of risks they're trying to manage, which are the tools that are available to manage those risks, and then use the tools that are appropriate for what they're trying to accomplish. I think I'd just close with that.
That's great. That's great. Steve, what's the big takeaway from you?
I certainly would concur with Janine's remark there, and reiterate the point that we are now talking about making sure that portfolio level considerations are being adequately considered, and at the same time figuring out how to do that while maximizing one's ability to preserve what already exists that's strong at a system level, to improve what needs to be improved at a systems level, and above all, to make sure that one is not undercutting the systems that already exist, those systems that have been built up over decades for the financial system, over centuries for social systems, and really over eons for the environmental systems. Those systems are worth preserving, are worth understanding how we can maximize their value without undercutting the long-term parts of their value. So I would emphasize that, and I would say that it's important that we recognize that this is true across all asset classes. We are not simply talking about equities here. The same kind of considerations are true and manifest themselves in slightly different ways. The ability of fixed income to address the problems in certain systems, such as community economic development, that are particularly useful to, a tool that's particularly appropriate to fixed income, are a little different from equities. Real estate, particularly appropriate to the system that constitutes our built environment. So those considerations will manifest themselves differently by different asset classes while still considering the specifics of portfolios. So
great, Steve. Great. Great. So go ahead into the next slide. So I'm going to interpret everybody's silence that you guys shock and awe them into silence with your knowledge and insights, which is great. And just thank everyone for participating, for Steve and Janine for making this happen. And just as some kind of next steps here, email addresses of myself, Steve, and Janine are up here. Feel free to follow up with us if you have any particular questions that you didn't feel comfortable expressing here but still want to answer. Otherwise, SASB will be sending out a blast to registrants with the recording of this session. And we will, our websites will continue to be updated with corresponding information. So thanks again to everyone, and I think that's a wrap.